Before we begin, a quick and important disclaimer. This video is intended for educational and entertainment purposes only and does not constitute legal, financial, or insurance advice. The concept of divorce insurance is a complex financial topic involving varying state regulations and contractual obligations. You should not make any financial decisions based solely on this content. We strongly recommend that you conduct your own due diligence and consult with a licensed insurance professional or a qualified attorney in your specific jurisdiction before pursuing any financial products mentioned. While the United States leads the world in many categories, there is one statistic that most Americans would rather ignore: our divorce rate. Every 36 seconds, a marriage in this country dissolves. That is roughly 2,400 divorces per day. But while we focus on the emotional wreckage, there is a silent, catastrophic financial crater left behind that most people never see coming until it is too late. Imagine losing 40% of your net worth, your primary residence, and half of your retirement savings in a single afternoon. Now, what if I told you that in specific pockets of the United States, from the high-asset corridors of the Northeast to the community property strongholds of the West, a growing number of people are looking for a way to hedge against this exact outcome? We are not talking about prenuptial agreements which can be thrown out by a judge on a whim. We are looking at a geographic phenomenon of interest in what is known as divorce insurance or marriage indemnity. Why is interest spiking in states like California and New York while remaining non-existent in the Midwest? Why are search trends for financial protection skyrocketing in regions with the highest cost of living? If you stay until the end of this deep dive series, you will understand the geographic drivers of marital risk, the historical trends of casualty insurance applied to domestic life, and the potential outcomes of protecting your assets before the first legal filing ever hits the desk. This is the geographic study of interest in divorce insurance across the United States. To understand why this is becoming a localized obsession, we have to look at the financial gravity of the American household. For the average American, a divorce is the single most significant financial event they will ever experience, surpassing the purchase of a home or the funding of a college education. Yet, despite the high statistical probability of a marriage ending, the insurance market for this risk is surprisingly fragmented. In this first part of our masterclass, we are examining the regional risk profiles that define why someone in a specific zip code is 5 times more likely to research divorce insurance than someone living just 3 states away. Let's start with the community property belt. If you live in states like California, Arizona, Texas, or Washington, the legal framework dictates that almost everything acquired during the marriage is owned 50-50. There is no his or hers, there is only ours. In these regions, the financial incentive to seek out a third-party indemnity product is massive. Consider a case study in Silicon Valley. A software engineer enters a marriage with 0 assets but, over 10 years, accumulates $3 million in vested stock options. Under community property laws, the moment a divorce is finalized, $1.5 million effectively vanishes from their balance sheet. Because the financial stakes are so high in these specific geographic zones, we see a concentrated spike in interest for supplemental financial protection. Contrast this with the equitable distribution states of the East Coast, such as New York or Florida. Here, the court decides what is fair, which isn't always a clean 50% split. This creates a different kind of anxiety, the anxiety of the unknown. When a person cannot predict the outcome of a court's ruling, they seek certainty through financial products. We are seeing historical trends where high-net-worth individuals in the tri-state area are investigating marriage insurance as a way to provide a guaranteed liquidity event if the marriage fails. This isn't about betting against love. It is about mitigating the catastrophic loss of liquidity that occurs when a judge orders the sale of a family business or a primary residence to satisfy a settlement. Geographically, we also have to look at the cost of divorce index. In states like California, the legal fees alone for a contested divorce can easily exceed $80,000. This is before a single asset is divided. When you look at the heat map of search interest for divorce insurance, it aligns almost perfectly with the areas of the country where legal services are most expensive. People are looking for a way to cover the frictional costs of ending a marriage. They want to know if there is a policy that will pay out a lump sum to cover the retainer for a top-tier attorney or the cost of a forensic accountant. Historically, the concept of divorce insurance, specifically products like wedlock, attempted to enter the U.S. market by framing marriage as a multi-decade financial contract. The data suggests that the interest was highest in regions with no-fault divorce laws. Before the 1970s, you had to prove a reason for divorce such as adultery or cruelty. Once California paved the way for no-fault divorce, the legal barriers fell, but the financial risks rose. In our current landscape, the geographic interest is driven by the realization that a marriage can end at any time, for any reason with zero warning. Furthermore, we must analyze the economic dependency factor across different U.S. regions. In traditional breadwinner regions, where there is a significant gap between the primary earner and the stay-at-home spouse, the interest in divorce insurance comes from both sides. The earner wants to protect the principal of their wealth, while the dependent spouse seeks a bridge to ensure they aren't left in a state of immediate poverty during the years-long litigation process. This is particularly prevalent in the affluent suburbs of the American South and the Midwest's executive hubs. But why now? Why are we seeing this trend peak in 2026? It is because we are currently in the midst of the great wealth transfer. As trillions of dollars move from baby boomers to millennials and Gen X, the recipients of these inheritances are terrified of losing that family legacy in a divorce settlement. If you live in a region like New England, where generational wealth is a pillar of the local economy, the search for inheritance protection via insurance products is at an all-time high. People are realizing that a prenuptial agreement is a shield, but insurance is a safety net. One protects the asset, the other provides the cash. Throughout this series, we are going to break down the actuarial math behind these interests. We will look at how insurance companies calculate marital longevity based on your education level, your geographic location, and even your credit score. We will examine the specific clauses that make these products viable or non-viable in different states. Most importantly, we are going to solve the problem of financial blindness. Most Americans go into marriage with a romantic view and leave with a scorched earth financial reality. By studying the geography of this interest, you will learn how to identify the risks specific to your state's laws and how the most financially savvy individuals in the country are preparing for potential outcomes. We are moving past the surface-level discussion of is divorce insurance a good idea, and moving into the where, why, and how of the American domestic economy. If you are living in a high-risk geographic zone, the information we are about to cover isn't just academic. It is a roadmap for asset preservation. We will dive into the specific divorce capitals of the U.S. and see what they can teach us about the future of marital risk management. This is a study of geography, law, and the cold, hard numbers of the American dream. To understand why search traffic for divorce insurance is pulsing in specific corridors of the American landscape, we have to look at the intersection of local law and personal finance. In the United States, your geographic location determines the rules of your financial undoing. We are currently seeing a massive divide between what are known as community property states and equitable distribution states. This isn't just a legal distinction. It is the primary driver of why a husband in San Diego might be desperately researching casualty insurance while a wife in Chicago feels relatively secure. Imagine a character named Mark. It is early 2026 and Mark lives in Austin, Texas, one of the 9 community property states. In Mark's world, the law is refreshingly simple but financially brutal. Everything he and his spouse earned or acquired from the moment they said I do until the day they file for divorce is owned exactly 50-50. If Mark spent the last decade building a tech startup that is now valued at $10 million, the state of Texas generally views $5 million of that as belonging to his spouse, regardless of whose name is on the stock certificates or who clocked the 80-hour weeks. In these geographic zones, the potential outcomes of a divorce are mathematically certain and devastatingly high. This creates a perfect environment for the insurance mindset. When the risk is a known 50% loss of all marital assets, the demand for a hedge, a way to offset that specific massive hit to the balance sheet, skyrockets. +1. Now shift the map to the Northeast. Imagine a woman named Sarah living in New York City. New York is an equitable distribution state. Here, the law does not mandate a 50-50 split. Instead, a judge looks at a list of factors, the length of the marriage, the health of the parties, and their future earning capacity, to decide what is fair. While this sounds more flexible, it introduces a high degree of volatility. In 2026, volatility is the enemy of financial planning. Case studies of high-net-worth divorces in Manhattan show that legal fees often balloon because neither party knows exactly where the finish line is. Because the outcome is unpredictable, the interest in divorce insurance in the Northeast isn't just about protecting the assets. It is about insuring against the legal process itself. +1. When we look at historical trends, we see that the most famous attempt at a divorce insurance product, known as wedlock, launched around 2010. It was structured in units. A policyholder would pay a monthly premium, roughly $16 for every $1,250 of coverage. The catch was a 4-year waiting period. This was designed to prevent people from buying a policy on Tuesday and filing for divorce on Wednesday. If you stayed married through that waiting period, the policy would begin to mature, adding value every year you remain together. While that specific product struggled with the complexities of state-by-state insurance regulations, the data it left behind is a goldmine for Geographic study. +3. The highest concentration of early adopters wasn't in the regions with the highest divorce rates, but in regions with the highest cost of living. This tells us something vital about the American public's character in 2026. Divorce insurance interest is a symptom of middle-class and upper-middle-class anxiety. In a city like Las Vegas, Nevada, which historically holds one of the highest divorce rates in the country, the interest in insurance is surprisingly lower than you might expect. This is because the barriers to entry and exit are so low that divorce is often treated as a recurring administrative task, rather than a singular financial apocalypse. However, if you move the lens to a city like San Francisco or Seattle, where the median home price is over $1 million, the story changes. In these regions, a divorce doesn't just mean a change in relationship status. It often means being forced out of the real estate market entirely. In 2026, the average interest rate on a mortgage makes refinancing a home to buy out a spouse nearly impossible for most families. This has led to a geographic spike in people looking for cash payout insurance products that could serve as a down payment on a new life. Consider the step-by-step reality of a high-stakes divorce in a community property state like California. Step 1. Every bank account, brokerage firm, and retirement fund is frozen or audited. Step 2. The primary residence is appraised, and in many cases ordered to be sold to liquidate the equity. Step 3. Both parties move from a 4-bedroom home into 2 separate 2-bedroom apartments that cost more than their original mortgage. For a family in this situation, a divorce insurance payout of $50,000 or $100,000 doesn't represent a profit. It represents a survival fund that prevents them from falling out of the middle class. We are also seeing a new geographic phenomenon: the rise of the gray divorce. Data from 2025 and 2026 shows that while divorce rates among younger generations are stabilizing or even falling, the rate for those over the age of 50 is tripling. These individuals are often living in states like Florida or Arizona, traditional retirement havens. For someone at 65, a divorce is a terminal financial event. They do not have another 20 years of career growth to recover their losses. This demographic is driving a massive amount of the search volume for marital indemnity. They aren't looking for a quick payout. They are looking for a way to ensure that their retirement remains viable if their partnership dissolves. Step back and look at the broader U.S. map. We see a tension zone running through the Bible Belt. Historically, these states have higher divorce rates but lower interest in financial products related to divorce. Why the disconnect? It comes down to cultural character. In many of these regions, divorce is still viewed through a moral lens rather than a purely financial one. The idea of insuring a marriage can feel like betting against the sanctity of the union. However, as the 2026 economy continues to put pressure on households, even these traditional regions are starting to show a change in behavior. We are seeing a transition from moral risk to financial risk management. But here is where it gets controversial. There is a specific type of geographic interest that insurance regulators are watching closely, and it involves something called adverse selection. This is a fancy insurance term for the idea that the only people who want to buy the insurance are the ones who know they are going to need it. If you live in a state like Oklahoma, which has a refined divorce rate of over 20 per 1,000 married women, the risk for an insurance company is incredibly high. This has led to a geographic insurance desert, where companies are hesitant to offer products because the probability of a payout is too certain. As we move into the next phase of this study, we have to ask the hard questions about the mechanics of these policies. How does a company actually price the risk of a broken heart? Is it possible to look at a zip code and predict the failure of a marriage with the same accuracy we use to predict a house fire or a car accident? We are about to look at the secret data sets that big insurance doesn't want you to see, the variables that determine your premium, from your educational background to your local unemployment rate. The geographic divide is widening. On one side of the country, people are viewing marriage as a permanent legal bond. On the other, it is being reevaluated as a high-risk financial venture, that requires a comprehensive suite of protection. But what happens when the very existence of these insurance products starts to change the way people behave within the marriage? Does having a safety net make it easier to walk away? In the next part, we are going to expose the actuarial profiles of the American spouse. We will look at how your credit score and your neighbor's divorce history might be determining your financial future in ways you never imagined. We are moving from the map to the spreadsheet, and the numbers are more shocking than the laws themselves. To understand the math behind the geography, we have to look at the hidden architecture of risk assessment that insurance companies use to evaluate a marriage. In the industry, this is known as the actuarial profile of a domestic union. When you search for divorce insurance in a high-interest region like Northern Virginia or the suburbs of Denver, you aren't just a person looking for a policy. You are a data point being cross-referenced against thousands of historical trends. In 2026, the complexity of this data has reached a fever pitch. Imagine a character named David. David is a 42-year-old project manager living in Charlotte, North Carolina. To an insurance company, David is not defined by his personality or his commitment to his vows, but by his zip code, his education level, and his debt-to-income ratio. Actuaries have discovered that the stability of a marriage often mirrors the stability of a person's financial footprint. This is why, in many experimental divorce insurance models, your credit score is one of the most significant predictors of your premium. High credit scores generally correlate with lower claims in the casualty world, and the same principle is being applied to marital indemnity. If David has a history of on-time payments and low revolving debt, he is viewed as a lower risk. Why? Because the data suggests that financial stress is the primary driver of marital dissolution in the United States. By insuring someone with a strong financial profile, the company is betting that the most common trigger for a payout, money arguments, is less likely to occur. Let's take a step-by-step look at how an actuarial table for divorce insurance is constructed. Step 1. Geographic baseline. The company looks at the average divorce rate in your specific county. If you live in a county with a high concentration of military families or high seasonal employment, the baseline risk is automatically adjusted upward. Step 2. Educational attainment. Historical trends consistently show that individuals with a 4-year degree or higher have lower divorce rates compared to those who did not complete high school. Step 3. The age of the marriage. This is the most critical variable. The risk of divorce is not a flat line. It is a bell curve. The first 7 to 10 years represent the highest risk period. The legendary 7-year itch is an actuarial reality. If David has been married for 12 years, his premium in 2026 would be significantly lower than someone who has been married for only 24 months, because he has already survived the highest risk window. Now consider an imagine-if scenario that sounds like science fiction, but is rooted in current data mining practices. Imagine if an insurance company looked at your social media behavior or your geographic movement patterns. In 2026, the digital breadcrumbs we leave behind are being analyzed to determine consumer behavior, and marital stability is no exception. In regions like Southern California, where tech savviness is at its peak, there is high interest in how lifestyle data could lower insurance premiums. If a couple frequently checks in at family-oriented locations, parks, or community centers, does that make them a better bet for an insurance company than a couple whose geographic data shows them at separate locations late into the night? While this raises massive privacy concerns, it is the direction the deep dive analytics are heading. We also have to discuss the spouse's risk profile. In a standard life insurance policy, you are the primary subject. In divorce insurance, the policy is effectively a bet on the behavior of two people. This creates a unique legal hurdle. In many states, you cannot take out an insurance policy on someone else without their insurable interest, and, often, their consent. This prevents a scenario where one spouse secretly insures the marriage, knowing they plan to file for divorce in the future. Case studies from early litigation in this space show that for a policy to be valid, both parties typically need to be aware of the coverage. This transparency requirement is one reason why interest is so high in collaborative law regions like Massachusetts, where couples are more likely to engage in transparent, long-term financial planning together. But let's look at the wealth concentration variable. In 2026, we are seeing a fascinating trend in the Sun Belt, states like Florida and Texas. These areas have seen a massive influx of remote workers moving from high-tax states. These individuals are bringing high salaries into regions with lower costs of living, creating a surplus of marital assets. This surplus is what people want to insure. If a couple moves from San Francisco to Miami, They might suddenly find themselves with $500,000 in home equity that they didn't have before. The search interest for divorce insurance in Florida is largely driven by this new wealth demographic. They are looking for a way to lock in their gains. They realize that while the state of Florida doesn't have an income tax, its equitable distribution laws can be a meat grinder for unprotected assets. Step by step, the process of applying for this type of protection in 2026 would look something like this. First, a full financial disclosure of both premarital and marital assets. Second, a psychological or relationship health assessment, which some emerging firms are using to weed out high-risk applicants. Third, the selection of a benefit trigger. Unlike a car accident where the damage is visible, a divorce has many stages. Does the insurance pay out upon the filing of the initial petition, or only when the final decree is signed? Historical trends suggest that trigger dispute is the #1 reason these policies fail. If the policy pays out at the filing, it might actually provide the financial fuel for someone to leave a marriage they were otherwise stuck in for financial reasons. This leads us to the concept of moral hazard. This is a fundamental principle in insurance that states when you are insured against a risk, you might be more likely to take that risk. If David in Charlotte knows that he has a $200,000 divorce insurance payout waiting for him, does he work as hard to save his marriage during a rough patch? Or does the financial safety net make the potential outcome of a divorce feel less like a catastrophe and more like a transition? This is the central ethical dilemma that state insurance commissioners are currently debating in 2026. It is why many states have been slow to approve these products. They fear that by providing a safety net for divorce, they might accidentally increase the divorce rate itself. The data, however, tells a more nuanced story. In regions where divorce insurance interest is highest, we also see higher than average participation in marriage counseling and financial literacy workshops. This suggests that the people looking for this insurance aren't looking for an easy out. Instead, they are risk-averse planners. They are the same people who have maxed out their 401ks, have 6 months of emergency savings, and carry umbrella liability insurance. For them, divorce insurance is simply the final piece of a comprehensive fortress finance strategy. As we examine the U.S. map, we see hotspots of interest in areas with the highest rates of late-term divorce. When a couple has been together for 25 years and their children have left the nest, the financial stakes change. The alimony burden in states like New Jersey or Connecticut can be permanent. For a high earner in these regions, the search for insurance is a search for a way to pre-fund a potential alimony obligation. They are looking for a product that would pay the ex-spouse so that their own retirement accounts remain untouched. This alimony indemnity is a subsector of the market that is seeing explosive growth in the 2026 search data. We have moved from the broad geography of the country into the very specific data points that define an individual's risk. But knowing your risk is only half the battle. The real question is, how do these companies actually hold the money? What happens if the insurance company itself goes bust before your marriage does? And more importantly, what are the underground alternatives that people are using in states where divorce insurance is still illegal? In the next part, we are going to dive into the shadow market of divorce protection. We will look at the creative, and sometimes legal gray area, financial structures that people are using in regions like the Midwest and the Deep South to achieve the same results as insurance without a formal policy. We are going to look at asset protection trusts and domestic asset protection regions that are acting as the unofficial divorce insurance of the American elite. The ways people are hiding and protecting money in 2026 will change the way you look at your own bank account. The shift from formal insurance products to the shadow market of asset protection is where the geographic study of marital risk becomes a masterclass in high-stakes financial chess. While the average resident in a high-interest state like Oregon or Illinois might be searching for a standard insurance policy, the top 1% of earners in those same regions are moving toward a concept known as the Domestic Asset Protection Trust, or DAPT. In 2026, the geography of these trusts is creating a massive internal migration of capital. To understand this, we have to look at why a couple living in a high-tax, community property state like California would suddenly move their liquid assets to a vault in South Dakota or Nevada. Imagine a character named Robert. Robert is a high-level executive in Los Angeles who has seen the potential outcomes of his colleagues' divorces. He knows that in California, his earnings are essentially split down the middle. However, Robert discovers that certain states have passed specific legislation to become asset havens. South Dakota, for example, does not have a rule against perpetuities, and offers some of the strongest privacy protections in the world. By moving his marital assets into a South Dakota-based DAPT, Robert isn't buying a policy from an insurance company. He is creating his own self-insured fortress. If a divorce filing happens in 2026, those assets are held in a jurisdiction that may not recognize the immediate reach of a California family court. This geographic arbitrage is the elite's version of divorce insurance. Let us break down the step-by-step mechanics of how these shadow insurance structures operate in 2026. Step 1: the look-back period. Much like the 4-year waiting period we saw with historical trends in divorce insurance, a DAPT requires a seasoning period. If Robert sets up the trust on a Monday and his spouse files for divorce on a Tuesday, the court will likely view this as a fraudulent conveyance, an attempt to hide assets. However, if that trust has been funded for 2, 3, or 5 years, it becomes a formidable barrier. Step 2: the independent trustee. To make this work, Robert cannot have direct control over the money. He must appoint a third-party trustee, usually a bank or a specialized trust company, based in that specific haven state. Step 3: discretionary distributions. The trustee has the power to decide when and if Robert gets money. Because Robert doesn't technically own the assets anymore, the trust does. Those assets are often excluded from the marital pot during a settlement. This brings us to a fascinating case study in the state of Nevada. Nevada is often cited in 2026 as the gold standard for this type of protection, because it has a relatively short 2-year statute of limitations on transfers to a DAPT. In the geographic study of divorce interest, we see a massive data spike, coming from individuals in surrounding states like Arizona and Utah who are looking to Nevada not for gambling, but for financial sheltering. These individuals are engaging in what experts call premarital shielding. They are looking at historical trends that show even the strongest prenuptial agreements can be litigated for years. By combining a prenup with a Nevada trust, they are creating a multi-layered defense system. But what about the 99% of Americans who cannot afford to set up a complex trust in South Dakota? This is where we see the rise of informal indemnity through family networks. In regions like the Deep South and parts of the Midwest, there is a cultural trend of asset parking. Imagine a scenario where a small business owner in Ohio anticipates a rough patch in their marriage. Historical trends in these regions show a spike in loans made to parents or siblings, or the sale of equipment to a friend for a fraction of its value. While these are often risky and can be flagged by forensic accountants in 2026, they represent a desperate, localized form of divorce insurance. People are willing to risk legal repercussions to ensure that the wealth they built doesn't evaporate in a courtroom. We also have to analyze the geographic impact of community debt. In states like Texas, it isn't just the assets that are split, it is the liabilities. If your spouse racks up $100,000 in credit card debt during the marriage, you might be on the hook for $50,000 of it, regardless of whether you ever saw the statements. This reality has driven a massive interest in liability insurance for married couples. In 2026, we are seeing people in these regions look for products that protect their individual credit scores and personal assets from the financial negligence of a spouse. It is a form of insurance that says, "I love you, but I don't trust your spending habits." Let's look at a real-world application of forensic mapping. In 2026, if you are going through a high-asset divorce in a city like Chicago, the first thing your legal team does is a geographic asset sweep. They are looking for offshore accounts, but more importantly, they are looking for domestic offshore accounts, those trusts in Delaware or Wyoming. The interest in divorce insurance in these regions is often a response to this technological arms race. When one side uses forensic AI to find every penny, the other side looks for an insurance product or a trust structure to move those pennies out of reach. Now imagine an imagine-if scenario regarding the future of work. It is late 2026, and the digital nomad lifestyle has become the norm for millions of Americans. If a couple is married in New York, works remotely from a van in Colorado, and eventually files for divorce while staying in Florida, which state's laws apply? This geographic confusion is a nightmare for financial planning, but it is a goldmine for the insurance industry. We are seeing a new type of jurisdictional insurance being researched. This would be a policy that pays out specifically to cover the costs of forum shopping, the legal process of trying to get your divorce heard in the state with the most favorable laws for your specific situation. Step by step, the forum shopping process looks like this. First, a spouse establishes residency in a more favorable state, often by renting an apartment or registering a vehicle there for 6 months. Second, they file for divorce in that state before the other spouse can file in their home state. Third, a legal battle ensues over which court has subject matter jurisdiction. The costs of this maneuver can be astronomical, and in 2026, search volume for divorce legal fee insurance in transitionary states like Nevada and Florida is at an all-time high. The character of the American public in 2026 is becoming increasingly transactional. We are seeing this reflected in the rise of micro-indemnity products in the gig economy. In regions with high concentrations of freelancers like Austin or Nashville, there is interest in income protection that triggers specifically during a marital separation. Since freelancers don't have the stability of a corporate salary, a divorce can be a career-ending event. They are looking for a way to ensure their business remains capitalized while they navigate the emotional and financial fallout of a split. As we look at these shadow markets and elite strategies, a clear picture emerges. The interest in divorce insurance across U.S. regions is not a monolith. It is a fragmented, complex response to a legal system that many feel is outdated. From the trust havens of the North to the community debt fears of the South, Americans are looking for a way to decouple their romantic lives from their financial survival. But there is a dark side to this geographic study that we haven't touched on yet. What happens when these insurance products and trust structures are used not for protection, but for financial coercion? What happens when one spouse uses their insured safety net to starve the other out of a fair settlement? In the next part, we are going to look at the predatory mechanics of marital finance. We will examine how the very tools designed to protect families are being weaponized in the most expensive courtrooms in the country. We are going to look at the nuclear option in divorce litigation and why your geographic location might make you a target for financial warfare. The concept of financial warfare in a marital context is not a plot from a thriller novel. It is a documented reality in high-stakes jurisdictions across the United States. As we move into 2026, the Geographic study of divorce insurance interest reveals a disturbing trend where these financial safety nets are being scrutinized as potential weapons of attrition. In regions like the Gold Coast of Connecticut or the tech hubs of the Pacific Northwest, the search for divorce insurance isn't always about a mutual safety net. Instead, it is increasingly about securing what is known in the legal world as a war chest. Imagine a character named Jennifer. Jennifer lives in a high-asset suburb of Seattle. She and her spouse have built a significant life together. But as the marriage fractures, Jennifer realizes that she is at a severe disadvantage. Her spouse controls the primary income streams and has the passwords to the brokerage accounts. In a traditional scenario, Jennifer would have to petition a court for temporary support, a process that can take months while she has zero access to cash. However, imagine if Jennifer had a private divorce insurance policy that she had maintained for years. The potential outcome of a filing suddenly changes. Instead of being starved into a lowball settlement, Jennifer receives an immediate liquidity event from her insurer. This cash allows her to hire a top-tier forensic team and a high-conflict litigator before her spouse even realizes the paperwork has been served. In the industry, this is often called the nuclear option because it bypasses the standard court-ordered discovery process for initial funding. Geographically, we see the highest interest in this specific tactical use of insurance in states with lengthy waiting periods for temporary alimony, such as Illinois or Pennsylvania. In these regions, if you don't have immediate cash, you lose the first 6 months of the legal battle by default. Case studies from 2025 show that the spouse who can afford the most aggressive initial posture often dictates the terms of the entire divorce. By injecting insurance capital into the equation, the power dynamic is fundamentally altered. Let us look at the step-by-step mechanics of how financial attrition works in a high-conflict geographic zone. Step 1. The dominant financial earner shifts liquid assets into less accessible vehicles, such as long-term bonds or private equity. Step 2. They decrease the lifestyle allowance of the dependent spouse, claiming a change in market conditions. Step 3. Once the dependent spouse is financially exhausted, the earner files for divorce, knowing the other party cannot afford a protracted legal fight. This is where the geography of interest in divorce insurance peaks. In cities like Boston or Washington, D.C., where the cost of a private investigator alone can reach $20,000, the insurance policy acts as a counter-attrition tool. It ensures that the potential outcomes are based on the law, not on who has the bigger bank account at the start of the trial. However, the weaponization of these tools goes both ways. In some 2026 case studies, we are seeing reverse attrition. This occurs when a spouse uses an insurance payout to fund frivolous litigation, filing motion after motion simply to burn through the other spouse's assets. Because the insurance company has footed the bill, the litigating spouse has no skin in the game. They can afford to be unreasonable because their legal fees are being covered by a casualty policy. This has led to a geographic backlash in the judicial systems of states like Texas and Florida. Judges in these regions are starting to ask for disclosure of third-party funding, which includes divorce insurance. If a judge sees that one side has a massive insurance payout dedicated solely to legal fees, they may adjust the final distribution of assets to compensate for the unfair advantage created by the policy. Historically, this mirrors the trends we saw with litigation funding in corporate law. Just as hedge funds began betting on the outcome of lawsuits, individuals are now using insurance to bet on their own domestic outcomes. This creates a moral hazard that is currently causing a massive debate in the American legal character. If you are insured against the cost of a divorce, are you less likely to settle? In 2026, data from mediation centers in California suggests that cases involving some form of divorce funding or insurance take 40% longer to resolve. The geographic hotspots for these delays are almost identical to the areas with the highest search volume for marital indemnity. Now consider the imagine if scenario regarding the corporate spouse. Imagine a scenario in a city like Charlotte or New York, where an executive's compensation package is 50% stock options that haven't yet vested. In a divorce, those future options are often the subject of intense coverture fraction calculations, determining how much of that future wealth belongs to the marriage. In this high-stress environment, we are seeing interest in gap insurance. This is a product that would pay out if the executive is fired or forced out during a divorce proceeding, which would otherwise wipe out the marital asset. This is a highly specific, geographic interest found in banking and tech corridors where job security is volatile. Step by step, the implementation of a defensive insurance strategy in 2026 involves, first, a jurisdictional audit to see if the state's courts even allow the use of insurance proceeds for legal fees. Second, a forensic baseline, where the insurance company requires a snapshot of all assets before issuing a policy. Third, a collusion check to ensure that the spouses aren't working together to defraud the insurance company, a common concern in no-fault states where a friendly divorce could be used to trigger a payout for both parties. We must also examine the psychological geography of this interest. In the Pacific Northwest, there is a cultural emphasis on conscious uncoupling and mediation. Here, the interest in divorce insurance is framed as a mediation fund, money meant to ensure a peaceful transition. Contrast this with the Northeast, where the interest is often framed in much more combative terms. The regional character of the U.S. deeply influences how these products are marketed and perceived. In 2026, the marketing data for these products shows that in the South, they are sold as family protection, while in the West, they are sold as financial independence. The reality of 2026 is that we are entering an era of domestic risk management. The geography of divorce insurance interest is a map of where Americans feel most vulnerable to the state's power to redistribute their wealth. Whether it is a nuclear option to escape a controlling situation or a fortress strategy to protect a family legacy, the move toward insuring the American marriage is accelerating. But what happens when the insurance companies start to lose? What happens when the actuarial bell curve of American divorce shifts so far that these products become unaffordable for everyone but the ultra-wealthy? In the next part, we are going to look at the market failure of divorce insurance. We will examine why some of the biggest names in the insurance industry refuse to touch this product and the black market policies that are popping up in their place. We are going to look at the rise of crowd-funded divorces and peer-to-peer marital risk pools. The traditional insurance model is breaking, and what is replacing it in the middle of the country will surprise you. We are moving from the courtroom to the boardroom to see who is actually profiting from the end of the American marriage. As the calendar turns deeper into 2026, the corporate boardroom has reached a startling conclusion. The traditional insurance model for marriage is fundamentally broken. When we look at the geographic data, we see a massive retreat by traditional carriers from states like Nevada and Florida. The reason is simple math. Insurance relies on the law of large numbers and the ability to predict risk across a massive pool of people. But marriage is not a car accident or a house fire. It is a choice. In the industry, this has led to a catastrophic failure of the standard underwriting process. Because of the sheer volume of high-risk applicants in certain U.S. regions, The premiums required to keep a company solvent would be so high that no one would buy the product. This has created a vacuum, and in the heart of the country, a new decentralized shadow economy is rising to fill it. Imagine a character named Michael. Michael lives in Columbus, Ohio. He is part of a growing demographic of professionals who find themselves in an insurance desert. He wants to protect his assets, but no major carrier will offer him a marital indemnity policy in his zip code. So, Michael turns to a 2026 phenomenon known as peer-to-peer marital risk pools. This is essentially a digital version of an old-world burial society or a farm cooperative. In this model, a group of 50 to 100 like-minded individuals, often within the same geographic region or professional industry, pool their capital into a smart contract or a private trust. They aren't paying a CEO. They are essentially insuring each other. If one member of the pool goes through a divorce, the collective fund provides a pre-negotiated payout to cover legal fees and immediate relocation costs. Let us break down the step-by-step mechanics of how these decentralized pools are functioning in the Midwest. Step 1: Vetting and entry. Unlike a traditional insurance company that uses a credit score, these pools often use social vetting. Members might be required to show proof of ongoing marriage counseling or financial transparency. Step 2: The capital contribution. Members pay a monthly or quarterly fee into a secured fund, often held in low-volatility assets. Step 3: The trigger event. This is where it gets complex. To prevent fraud, the pool often requires a majority vote or a third-party legal certification that the divorce was not collusive. This is a radical departure from the faceless corporate models of the past. It is a community-based response to a market failure. Historically, we can look at the trend of healthcare sharing ministries as a precursor to this. Millions of Americans opted out of traditional health insurance in favor of community-based sharing. In 2026, we are seeing the same logic applied to divorce. In regions where the cultural character prizes self-reliance over corporate intervention, think the Great Plains and the Mountain West, these risk pools are seeing double-digit growth. They are marketed not as insurance, but as a marital solidarity fund. By framing it this way, they often bypass the strict regulations that govern the insurance industry, though this puts them in a legal gray area that is currently being challenged in courtrooms from Denver to Des Moines. But why did the big companies fail? To understand that, we have to look at the death spiral of the divorce insurance market. In a typical insurance market, you need a mix of high-risk and low-risk people. If only the high-risk people buy in, the payouts exceed the premiums, the company raises prices, the low-risk people leave, and the company collapses. Case studies of early 2020 startups in this space show that they couldn't attract the happily married couples who would provide the necessary capital cushion. By 2026, the only way a traditional company can stay afloat is by offering bundled life events insurance. This is a product where you aren't just insuring against divorce. You are insuring against a suite of life disruptions, including job loss, disability, and marital dissolution. Geographically, this is the only way the product has survived in high-volatility markets like the Northeast. Now, let us consider the boardroom perspective. Who is actually profiting if the insurance companies are leaving? The answer lies in the divorce tech sector. In 2026, venture capital is flowing into platforms that use predictive AI to assist in the pre-divorce phase. These companies sell subscriptions to spouses who want to monitor their marital health or automate the gathering of financial records in case of a split. While not an insurance policy in the legal sense, it functions as information insurance. If you live in a high-conflict state like New Jersey, having a cloud-based, unchangeable record of every dollar spent during the marriage is more valuable than a cash payout. This is the new insurance for the digital age. Data as a shield. Step by step, the data as insurance model works like this. First, the user connects all financial accounts to a secure, third-party platform. Second, the AI flags any dissipation of assets, such as large cash withdrawals or hidden accounts created by a spouse. Third, if a divorce is filed, the platform generates a comprehensive financial marital map that is admissible in court. In 2026, search interest for these marital auditing tools has surpassed interest in traditional insurance in cities like Chicago and Philadelphia. People have realized that in a courtroom a payout is good but proof is better. However, we cannot ignore the rise of crowd-funded divorces. In lower-income geographic regions, where neither a DAPT nor a high-end insurance policy is an option, we are seeing the emergence of justice platforms. These are sites where a person can tell their story and strangers can donate to their legal fund in exchange for a percentage of the final settlement. While this sounds like something out of a dystopian novel, it is a response to the massive justice gap in the U.S. If you are a stay-at-home parent in a state like Tennessee with no access to funds, and you cannot afford insurance, this becomes your only potential outcome for a fair trial. The ethics of investing in divorce are a major talking point for 2026 legal scholars, as it effectively turns a domestic dispute into a tradable asset. Imagine if scenario where your insurance premium was adjusted in real time, based on your GPS data. If the insurance company sees that you and your spouse haven't been in the same geographic location for more than 8 hours a month, your divorce risk profile spikes. In 2026, the intersection of wearable tech and insurance underwriting is a reality. In tech-heavy regions like the Research Triangle in North Carolina, there are beta programs where couples can opt in to biometric monitoring in exchange for lower life and casualty insurance rates. The theory is that lower stress levels and frequent co-location correlate with marital longevity. This brings us to the geographic paradox. The areas with the highest interest in protecting assets are often the areas with the most stable marriages, while the areas with the highest divorce rates often have the least amount of financial protection. This protection gap is the single biggest challenge facing the American economy in 2026. When a marriage fails in a region without these safety nets, the resulting poverty and reliance on state services create a massive drain on local taxpayers. This is why we are starting to see some state legislatures, particularly in the Pacific Northwest, discuss public divorce insurance, a state-mandated fund, similar to unemployment insurance, that would provide a baseline of support for families in transition. As the traditional corporate models continue to retreat, the map of the United States is being redrawn by these localized, community, and tech-driven alternatives. We are moving away from a world of policies and into a world of protocols. Whether it is a peer-to-peer pool in Ohio or a data monitoring suite in North Carolina, the goal remains the same: to mitigate the catastrophic financial impact of a broken contract. But what happens when these protocols fail? What happens when the data shield is hacked or the peer-to-peer pool runs out of money? In the next part, we are going to look at the catastrophe scenarios of the marital insurance world. We will examine the legal battles of 2026 where these new financial structures are being torn apart by the very courts they were designed to bypass. We are going into the gray markets of international marital indemnity and why some Americans are looking to offshore their entire marriage to avoid U.S. domestic law. The lengths people will go to for financial security in 2026 are about to get even more extreme. The phenomenon of offshoring marital risk has transformed from a whispered tactic among the ultra-wealthy into a full-scale geographic movement in 2026. As domestic insurance products face regulatory bottlenecks and market failures across the United States, a new class of proactive planners is looking toward international jurisdictions to find what the American market cannot provide. This is the era of the globalized marriage contract. When search interest for divorce insurance hits a wall in high-regulation states like New York or California, the data shows a secondary spike in queries for international asset protection trusts and offshore marital indemnity structures. This isn't just about avoiding taxes. It is about creating a firewall that is geographically outside the reach of a local family court judge. Imagine a character named Thomas. Thomas is a successful consultant living in Miami, Florida. In 2026, Thomas views his marriage not just through an emotional lens, but as a high-stakes financial partnership subject to the specific equitable distribution laws of his state. He has watched friends lose 50% of their businesses in a single court ruling. After finding that traditional U.S.-based divorce insurance is either too expensive or too limited in its payout triggers, Thomas decides to explore a Cook Islands trust. By transferring his primary business interests into an offshore entity located thousands of miles away, he is essentially self-insuring his lifestyle. If his marriage dissolves in Florida, the local court may issue a decree ordering the division of those assets, but the trustee in the Cook Islands, operating under entirely different legal statutes, may refuse to comply. This creates a potential outcome where the offshore entity acts as the ultimate indemnity policy, ensuring that the core of Thomas's wealth remains intact regardless of the domestic legal storm. To understand the mechanics of this extreme geographic pivot, we must look at the step-by-step process of jurisdictional arbitrage. Step 1. The selection of the haven. In 2026, the primary players are the Cook Islands, Nevis, and Belize. These regions have historical trends of refusing to recognize foreign court orders. Step 2. The integration of the marital clause. Unlike a standard asset protection trust, these are being drafted with specific divorce insurance triggers. For example, the trust might be structured to automatically distribute a set amount of liquidity to a spouse upon a legal separation, but only if they waive their rights to the trust's principal. Step 3. The physical separation of capital. The money is moved into international brokerage accounts that do not have a presence in the United States, making it nearly impossible for a domestic court to freeze the funds. This geographic study reveals that the highest interest in these offshore methods comes from the U.S. power corridors, the Washington-Boston megalopolis and the California coast. In these areas, the sheer density of high-net-worth individuals has created a competitive market for offshore marital consultants. These are not traditional insurance agents. They are a hybrid of international law experts and financial planners. They are selling a product that is effectively a do-it-yourself insurance policy. Case studies from early 2026 suggest that these structures are being used as a massive leverage tool in settlement negotiations. When one spouse knows that the other's wealth is locked behind an international legal fortress, they are often forced to accept a more modest, predictable settlement rather than risking a decade of international litigation. However, the risk of catastrophe scenarios in this space is massive. Let us consider an imagine-if scenario where the geopolitical landscape shifts. Imagine if a U.S. federal judge, frustrated by the rise of offshore marital shielding, decides to hold a citizen in contempt of court until they repatriate the funds. In 2026, we are seeing the first major legal tests of this contempt power. A person who thought they were insured by their offshore trust might find themselves sitting in a domestic jail cell because their safety net is viewed as an obstruction of justice. This is the dark side of the geographic study. The further you move your financial protection away from your physical location, the more you risk a total disconnect between your legal obligations and your financial reality. Historical trends show that whenever the U.S. public feels that domestic systems are failing, they look for external stability. In the 1970s, it was offshore banking. In the 2020s, it is the offshoring of the marriage itself. This has led to the rise of international premarital mediation. High-interest regions in the U.S. are seeing a boom in couples who travel to neutral third-party countries like Switzerland to sign their financial agreements. The theory is that a contract signed and domiciled in a foreign jurisdiction might be harder to overturn in a local U.S. court. This is a form of contractual insurance. It is the idea that by geographically distancing the agreement from the marriage's daily life, you can protect the integrity of the financial terms. But let's look at the step-by-step breakdown of what happens when these offshore safety nets fail. Step 1. The non-titled spouse hires a specialized global bounty hunter firm to track the movement of crypto assets and offshore wires. Step 2. The forensic team identifies a U.S. nexus, perhaps a small bank branch or a piece of real estate that can be seized as a substitute asset for the money hidden abroad. Step 3. A legal tug-of-war begins between international jurisdictions. In 2026, these cases are lasting longer and costing more than the original assets were worth. This has created a secondary search spike for litigation insurance for offshore disputes. People are literally trying to insure their insurance. This brings us to the character of the 2026 American. We are seeing a move toward what sociologists call atomized finance. Instead of relying on a community pool or a national carrier, individuals are trying to build their own private islands of security. In regions with high levels of institutional distrust, such as the Intermountain West and the Deep South, the interest in sovereign marital wealth is at an all-time high. These individuals aren't just looking for a payout. They are looking for a way to opt out of the state's domestic relations laws entirely. They view divorce insurance as a form of financial sovereignty. But what about the ethical cost? In the quest for geographic security, are we destroying the very concept of a shared marital life? Case studies from high-conflict divorces in 2026 show that once one spouse discovers the other has offshore insurance or shields, the trust is irrevocably broken. The potential outcomes shift from a possible reconciliation to a scorched earth legal battle. The geographic study of this interest shows that while these tools provide a financial floor, they often create a psychological ceiling that prevents the marriage from ever recovering from a minor crisis. We are also seeing the emergence of regional reciprocity battles. Some U.S. states are beginning to pass laws that specifically target citizens who use offshore trusts to bypass domestic divorce settlements. For example, a new 2026 legislative trend in states like California involves add-back statutes, where a judge can assume the offshore money exists and add it back to the domestic pot, giving the other spouse 100% of the local assets to make up for the hidden international ones. This makes the offshore insurance worse than useless. It actually triggers a total loss of domestic assets. As we look at the map of 2026, the lines between domestic and international, between insured and uninsured, are blurring. The American public is caught in a desperate search for certainty in an inherently uncertain relationship. From the Cook Islands to the local county courthouse, the geography of marital risk is a landscape of high-stakes maneuvers and hidden traps. But the most significant development isn't happening in a tropical tax haven. It is happening in the world of digital assets. In the next part, we are going to look at the blockchain divorce. We will examine how smart contracts and decentralized finance are being used to create automated divorce insurance that requires no insurance company, no judge, and no offshore trustee. We are going to look at the rise of programmable marriage and why the next generation of spouses in the US might be ditching paper contracts for code. The future of marital indemnity is moving into the cloud, and the implications for the American legal system are nothing short of revolutionary. The intersection of blockchain technology and marital risk management has created a new geographic frontier for divorce insurance interest in 2026. As we move away from traditional paper-based policies and offshore trusts, the data shows a massive concentration of search volume in the crypto-heavy regions of the United States, specifically the tech corridors of Miami, the burgeoning Bitcoin hubs of Texas, and the Silicon Slopes of Utah. In these areas, the American character is shifting toward a belief in programmable trust. They are looking for a way to automate the financial consequences of a marital breakdown, removing the human element of a judge or an insurance adjuster entirely. This is the era of the smart marriage contract, a decentralized version of marital indemnity that operates on the logic of if-then statements rather than legal arguments. Imagine a character named Kevin. Kevin is a 34-year-old software architect living in Salt Lake City. In 2026, Kevin views the traditional legal system as slow, expensive, and biased. Instead of seeking a standard insurance policy from a legacy carrier, Kevin and his spouse decide to utilize a decentralized autonomous organization, or DAO, specifically designed for marital risk pooling. They contribute a portion of their digital assets into a multi-signature wallet. The smart contract governing this wallet is programmed with a specific set of parameters. If a legal filing for divorce is detected via an integrated data oracle, a service that feeds real-world information into the blockchain, the contract automatically triggers a pre-negotiated distribution of funds. There is no waiting for a court order or an insurance claim approval. The code executes the payout immediately to provide liquidity for both parties. This represents the ultimate form of automated divorce insurance. To understand the step-by-step mechanics of this technological shift, we must look at how these digital oracles function within the U.S. legal landscape. Step 1. The Oracle integration. The smart contract is linked to public court records. In 2026, many U.S. counties have moved to blockchain-based filing systems, allowing for seamless data transfer. Step 2. The Benefit trigger. The contract is set to recognize a specific status change in the couple's legal standing. Step 3. Automated liquidation. Once the trigger is met, the contract can liquidate a portion of the held assets, perhaps stablecoins or staked tokens, and distribute them to separate pre-verified wallets. In the Geographic study of this trend, we see that interest is highest in states like Wyoming, which has pioneered the legal recognition of DAOs and smart contracts as valid legal entities. Historical trends in the crypto space show that whenever a traditional financial product fails, a decentralized version emerges to replace it. Because traditional divorce insurance has struggled with the moral hazard and adverse selection problems, the blockchain model attempts to solve this through collateralized risk. Unlike an insurance policy where you pay a small premium for a large potential payout, these 2026 smart contracts often require the participants to lock up their own capital. It is essentially a high-tech escrow account that serves as a self-funded insurance policy. Case studies from the early 2020s regarding smart prenups laid the groundwork for this, but in 2026, we are seeing these move into the indemnity space, where third-party investors can actually provide the liquidity for the pool in exchange for a small percentage of the stability fee paid by the married couple. This brings us to the concept of algorithmic alimony. In the geographic hubs of the Northeast, where alimony battles are notoriously protracted, There is growing interest in using smart contracts to automate monthly support payments. Imagine if scenario where the alimony amount is not fixed by a judge, but is adjusted in real time based on the consumer price index or the relative income of both parties as reported to the blockchain through verified tax APIs. In 2026, this is being researched as a way to reduce the frictional costs of divorce. By ensuring the payment process through code, the parties avoid the thousands of dollars in legal fees typically spent on enforcement actions. The insurance here isn't a lump sum. It is the insurance of a continuous, friction-free financial transition. However, the Geographic study also reveals a significant digital divide. While the tech hubs are embracing these tools, the vast majority of the American public in the Midwest and South remain skeptical. This creates a jurisdictional conflict. If a couple moves from a crypto-friendly state like Wyoming to a more traditional state like Tennessee, will the local courts respect the automated execution of a smart contract? In 2026, we are seeing the first major code versus court battles. A judge in Nashville might view an automated blockchain payout as an unauthorized transfer of marital property and attempt to claw the money back. This has led to a search spike for blockchain legal defense insurance, a product that protects your right to use your own code-based financial structures. Step by step, the code versus court conflict looks like this. First, the smart contract executes the payout upon a divorce filing. Second, the disadvantaged spouse, despite having agreed to the code years prior, petitions a state court to invalidate the transfer. Third, the court issues a freeze order on any connected centralized exchanges. Fourth, a legal battle ensues over whether the blockchain's finality of settlement supersedes the state's power to distribute assets equitably. This tension is the primary reason why interest in these products is so concentrated in regions with specific digital asset protection laws. We must also analyze the character of the 2026 investor. Many individuals researching divorce insurance today are also heavily invested in decentralized finance, or DeFi. They view marriage as just another liquidity pair in their life's portfolio. They are looking for impermanent loss insurance, a concept borrowed from crypto trading where you are protected if the value of your combined assets changes significantly during a specific period. In a marital context, this translates to a product that pays out if the market value of the couple's shared life, their home, their joint business, their combined retirement, takes a hit specifically due to the timing of a divorce during an economic downturn. The data suggests that the potential outcomes of using these decentralized tools are still being mapped. In some case studies, the automation of the payout led to a much smoother, less emotional separation because the financial decisions were made years in advance by neutral code. In other cases, the lack of human discretion led to black swan events where the contract triggered due to a technical error or a misfiled court document, causing financial chaos before the couple had even decided to end the marriage. This technological risk is the new frontier of the insurance world. People are now looking for smart contract audit insurance to protect their divorce insurance. As we examine the US map in 2026, we see a patchwork of digital havens and legal strongholds. The interest in blockchain-based divorce protection is more than a trend. It is a fundamental reevaluation of how we define a contract. If a marriage is a contract and a contract is code, then the insurance of that marriage must also be code. This realization is pushing the American legal system toward a breaking point, where the geography of your physical home matters less than the geography of the server where your marital contract is hosted. But what happens when the code is used for something more sinister? What happens when automated payouts are used to hide assets or bypass child support obligations? In the next part, we are going to look at the dark side of the blockchain divorce. We will examine the ghost wallets and privacy coins that are being used to create invisible divorce insurance, wealth that can never be found by a forensic accountant. We are going into the world of zero-knowledge proofs and why the future of marital finance might be becoming completely untraceable. The battle for transparency in the American marriage is about to collide with the technology of total anonymity. The transition from the transparent ledger of the blockchain to the opaque world of total anonymity represents the final, most controversial frontier in the Geographic study of divorce insurance interest. As we enter the second quarter of 2026, the search data reveals a chilling trend: a surge in interest for what is being called invisible divorce insurance. In regions with the most aggressive asset discovery laws, such as California and New Jersey, a subsection of the population is moving away from traditional indemnity products and toward privacy-preserving technologies. This isn't just about hiding a bank account. It is about using advanced cryptography to create a financial existence that is geographically everywhere, but legally nowhere. Imagine a character named Elena. Elena is a high-earning architect in Chicago. She has seen historical trends where forensic accountants successfully crack open standard cryptocurrency wallets or trace offshore wires. In 2026, Elena discovers the concept of zero-knowledge proofs or ZK proofs. This technology allows a person to prove they have the funds to cover a transaction or a legal obligation without revealing the source, the amount, or the location of those funds. Elena begins to investigate ZK-based insurance protocols. These products offer a payout if a marriage dissolves, but the entire policy, from the premium payments to the final claim, is shielded from public view and traditional subpoenas. To a local Illinois court, Elena appears to have a standard level of savings. In reality, she has an invisible safety net that can be triggered the moment a divorce decree is finalized, providing her with immediate, untraceable liquidity. To understand the step-by-step mechanics of this dark insurance market, we have to look at how anonymity is built into the financial architecture of 2026. Step 1. The use of privacy coins. While Bitcoin is a public ledger, coins like Monero or Shielded's cash transactions are designed to obfuscate the sender, receiver, and amount. Step 2. The integration of mixers or tumblers that are now operating through decentralized, non-custodial protocols. Step 3. The stealth payout. When the insurance trigger is met, the funds are not sent to a traditional bank account, but are distributed across a series of ghost wallets that have no identifiable link to the policyholder. In our Geographic study, we see that interest in these methods is peaking in states that have recently passed aggressive transparency acts, where the government requires the registration of all digital assets. The public's character in 2026 is becoming one of strategic silence. Historical trends in the insurance industry show that when transparency becomes mandatory, the market for anonymity becomes a premium sector. We are seeing a cat-and-mouse game between forensic technology and privacy tools. In 2025, specialized firms in New York claimed they could de-anonymize 90% of crypto transactions. By 2026, the introduction of Layer 2 privacy protocols has brought that number back down to nearly zero for those using advanced tools. This has created a massive demand for privacy consultants in the divorce space. These individuals act as the architects of the invisible safety net, ensuring that the potential outcomes of a divorce do not include the total exposure of a person's private wealth. Consider an imagine-if scenario where the very concept of discovery in a legal case becomes obsolete. Imagine a divorce trial in 2026 where one spouse's attorney knows, with absolute certainty, that the other spouse has millions in invisible insurance, but they cannot prove it to a judge. The technology of ZK proofs means the court cannot compel the disclosure of something it cannot see. This leads to a stalemate of information. The Geographic study shows that this is most prevalent in the Wealth Islands of the United States, places like Palm Beach, the Hamptons, and Aspen. In these high-stakes environments, the ability to maintain financial anonymity is the ultimate insurance policy. Step by step, the anonymity arms race in 2026 looks like this. First, the court orders a full forensic audit of all digital footprints. Second, the audited party reveals only public-facing assets while the invisible insurance remains in a shielded pool. Third, the forensic firm uses AI pattern recognition to look for missing time or missing capital in the party's financial history. Fourth, the audited party uses decoy transactions to create a false trail of financial activity. The costs of these audits are skyrocketing, leading to another secondary market, audit defense insurance, which pays for the legal and technical experts needed to protect your privacy during a divorce. However, we must address the social cost of this technology. In 2026, the rise of invisible wealth is creating a two-tiered justice system. Those who can afford the high technical barrier to entry for ZK-based insurance can effectively opt out of the state's distribution laws, while everyone else remains subject to total transparency. This is causing a geographic backlash in the legislative halls of the Midwest. We are seeing presumption of wealth bills being introduced in states like Michigan and Ohio. These laws would allow a judge to presume that a spouse is hiding assets if they utilize privacy-preserving technologies, essentially shifting the burden of proof onto the individual to prove they don't have hidden insurance. Case studies from early 2026 highlight the technical fragility of these systems. In one notable case in Virginia, A husband used a series of privacy protocols to hide a $3 million insurance payout. However, he made a single mistake. He accessed his ghost wallet from a home Wi-Fi network without a properly configured VPN. That single geographic data point allowed a forensic team to link his identity to the untraceable funds. The potential outcome was not just the loss of the money, but a criminal charge for perjury and a total wipeout in the civil divorce settlement. This proves that while the technology is powerful, the human element remains the weakest link in any insurance strategy. The character of the American spouse in 2026 is evolving into that of a digital sovereign. People are no longer content with the potential outcomes provided by a state-regulated insurance product. They want to dictate their own terms, and they are using the dark corners of the internet to do it. The geography of interest in divorce insurance has moved from the physical map of the US to the topological map of the internet. It is a world of nodes, encrypted tunnels, and private keys. But as we reach the pinnacle of this study, we have to look at the final, most terrifying possibility. What happens when the insurance isn't for the money, but for the identity itself? We are seeing the rise of identity decoupling in the most extreme divorce cases. This is where individuals use AI and deepfake technology to create financial avatars that live a separate life, making it impossible to determine which assets belong to the real person and which belong to the digital one. We are moving from hidden money to hidden lives. In the final part of this masterclass, we are going to pull back the curtain on the ultimate endgame. We will look at the post-geographic divorce and how the concept of a US region might become irrelevant in a world of digital citizenship. We will explore the final summary of the 2026 marital risk landscape and give you the step-by-step framework for understanding where this is all heading. The boundaries of law, geography, and reality are about to disappear entirely. Prepare for the conclusion of the geographic study of interest in divorce insurance. As we conclude our geographic study of interest in divorce insurance, we are standing on the precipice of a post-geographic reality. By late 2026, the traditional lines that defined American marital law are being redrawn by technology that moves faster than any state legislature. We are seeing a fundamental shift in the American public's character, from reactive participants in a legal system to proactive architects of their own financial sovereignty. The deep dive data suggests that the future of divorce insurance isn't a policy you buy from an office in Hartford, Connecticut. It is a decentralized, automated, and often invisible framework that follows you across state lines and national borders. Imagine a character named Marcus. Marcus is a digital nomad who works for a decentralized finance firm. In 2026, Marcus is legally a resident of Wyoming because of its favorable digital asset laws, but he spends most of his year in short-term rentals in Tennessee and Florida. When Marcus enters a marriage, he doesn't look for a local attorney to draft a prenuptial agreement that might be tossed out by a judge in a different state. Instead, he utilizes a concept known as digital citizenship marital bonds. This is a private code-based agreement that exists on a global blockchain. It includes a built-in indemnity pool funded by his diversified crypto portfolio. If the marriage dissolves while he is in Miami, the local Florida courts might struggle to assert jurisdiction over a contract that is domiciled in a digital Wyoming DAO and executed by a smart contract. For Marcus, the geography of his divorce is not where he lives, but where his data is stored. To understand the final step-by-step evolution of this trend, we have to look at the 3 pillars of 2026 marital risk management. Pillar 1. Automated transparency. Historical trends show that the most expensive part of a divorce is the discovery phase, finding the money. In 2026, proactive couples are using AI-driven financial monitors that provide a real-time, immutable audit of all marital and non-marital assets. This functions as a form of procedural insurance. It ensures that neither party can hide assets, which theoretically reduces the potential outcomes of a high-conflict litigation. Pillar 2. Pre-funded liquidity. Instead of traditional monthly premiums, we see a move toward escrowed indemnity. Couples are locking up a specific percentage of their net worth in a joint transition fund that only unlocks upon a legal filing. Pillar 3. Jurisdictional arbitrage. People are now intentionally choosing their primary residence based on which state's divorce insurance and trust shield laws are most robust. This has led to a fascinating case study in the state of South Dakota. In 2026, South Dakota has seen a spike in virtual residency for high-net-worth individuals who want to take advantage of its domestic asset protection trust laws. These individuals may never set foot in the state, yet their marriage's financial core is anchored there. When we look at the geographic search interest, we see a shadow map, where the people with the most to lose are virtually migrating their marriages to the most protective jurisdictions. This is the post-geographic reality. Your physical marriage is in one state, but your financial marriage is in another. But what are the potential outcomes of this total fragmentation of marital law? Case studies from early 2026 suggest a growing legal dualism. On one hand, you have the traditional court system, which is increasingly overwhelmed and underfunded. On the other, you have the private justice system used by those who have insured their marriages through private contracts and digital pools. This creates a scenario where two neighbors in the same zip code in Ohio could have two completely different divorce experiences. One spends 3 years in a local courthouse fighting over a pension, while the other's divorce is finalized in 3 weeks via a pre-programmed smart contract and a private mediator. Step by step, the private justice model works like this. First, the couple opts out of the state's default divorce laws at the time of marriage by signing a private arbitration and indemnity agreement. Second, the agreement is backed by a dedicated insurance bond or a collateralized digital pool. Third, if a split occurs, the private judge or smart contract oracle verifies the trigger and executes the pre-negotiated payout. Fourth, the local court is presented with a final settlement that it is often legally required to accept because of the private contract's validity. In 2026, the search interest for private divorce courts has increased by 400% in high-cost states like California and New York. However, we must consider the imagine if scenario regarding the AI mediator. Imagine if, in 2026, the insurance company providing your marital indemnity policy also provides a mandatory AI counselor that monitors your communication for signs of distress. If the AI detects a high probability of divorce, it might automatically lower your coverage or raise your premium, citing an increased risk of loss. This sounds invasive, but in a world of data-driven insurance, it is the logical conclusion. The geography of your interest in divorce insurance is now being monitored at the level of your keystrokes and your voice inflections. Historically, insurance has always been about the socialization of risk. But in 2026, the geography of interest shows a move toward the individualization of risk. We are no longer willing to pay for the bad marriages of others through a general insurance pool. We want a product that reflects our specific behavior, our specific assets, and our specific geographic strategy. This is the balkanization of the American family. As we've seen throughout this study, the more tools we have to protect ourselves, the more we tend to separate our interests from our partners. As we close this deep dive masterclass, the final lesson is clear. The United States is no longer a single legal landscape for marriage. It is a patchwork of risk zones and protection havens. Whether you are a Mark in Austin, a Sarah in New York, or a Marcus in the cloud, your geographic location, both physical and digital, will determine the potential outcomes of your most personal partnership. The search for divorce insurance is, at its heart, a search for control in a world where the only thing guaranteed is change. But even as we master the financial and technological shields of 2026, a new question is emerging on the horizon. If we can insure against the financial loss of a marriage, can we ever truly be all in on the emotional connection? And as these tools become more advanced, will the state eventually step in to regulate the private sovereignty of the American household? In our next deep dive series, we are going to explore the legislative counterstrike. We will look at the secret bills being drafted in 2026 to tax invisible wealth, and the federal push to create a national marriage database. The battle between the individual and the state for the future of the family has only just begun. The map is being redrawn again, and the next shift will be the most explosive one yet.